For millions of us, it's the absolute pinnacle of the dream, right? Getting the keys to your own front door, the foundation of your future, and at the very heart of that dream is one single powerful financial tool, the mortgage. But what really is this thing we all rely on? Is it a simple, straightforward path to owning a home? Or is it, well, something way more complicated? Let's unpack the two very different sides of this story. So you have to ask, is owning a home the ultimate symbol of security and freedom? Or could the very thing designed to get you there actually be a kind of trap? That's the huge question we're digging into today, by looking at two completely different, and I mean radically different, perspectives on the world of mortgages. All right, here's how we're going to break it all down. First, we'll talk about the thing everyone agrees on, the dream of a home and the debt that comes with it. Then we'll dive into two totally conflicting views. First up, the idea that fraud happens inside a legitimate system. And then the much more radical idea that the fraud is the system. After that, we'll see how each side fights back. And we'll wrap it all up with a final, pretty unsettling question. Okay, let's start at the beginning. For almost everybody, the dream of owning a home just isn't possible by paying in cash. It takes a loan, a pledge, a mortgage. And right there, that's where the dream meets the debt.
And, this isn't just any loan. We are talking about the single biggest financial commitment that most people will ever make in their entire lives. The sheer size of this debt is exactly what makes the whole issue of fraud so incredibly high stakes.
So let's dive into that first perspective. This is the official view, the one held by law enforcement, by the banking industry. The idea here is that the mortgage system itself is basically sound, but, criminals and bad actors find ways to exploit it for their own gain. In other words, we're talking about fraud in the system. The FBI actually has a really clear definition for this. At its core, mortgage fraud is any kind of major lie, a misstatement, a misrepresentation, even leaving something important out that a lender relies on when they're deciding whether to give you a loan. Basically, it's lying to get money. And that's the legal framework the government uses. And the scale of this problem, it is absolutely staggering. Just look at this number. According to a 2008 FBI report, suspicious activity tied to mortgage fraud led to over $1.4 billion in losses. And that's in just a single fiscal year. So from the government's point of view, this isn't some minor problem. It's a massive criminal enterprise. So how does this kind of fraud actually play out in the real world? Well, law enforcement points to a few common schemes. You've got things like foreclosure rescue scams, where criminals swoop in and promise to help struggling homeowners, but it's all phantom help. They just end up stealing their money or, even worse, the title to their home. Then there are things like builder bailouts with inflated property values and illegal property flipping. And this is where it gets really ugly. These aren't just numbers on a spreadsheet. When this kind of fraud becomes widespread, it can kick off a vicious cycle of foreclosures and abandoned homes, which can literally destabilize entire communities and tank property values for everyone. But hold on, that is just one side of the story. There is a completely different perspective out there that argues that all those schemes we just talked about, they're just symptoms of a much, much deeper sickness. What if the problem isn't just a few bad apples, but the entire barrel is rotten? What if the crime is the system itself? And that brings us to our second, really alternative perspective, the belief that the modern mortgage system isn't just being exploited by crooks, but that it is, by its very design, a fraud. Now, people who hold this view often start with the word itself, mortgage. If you break it down, it comes from Old French, and it literally means dead pledge. The idea is that it's a pledge that lasts until the debt is paid off, or until the lender takes the property. It's a pledge to the death. This entire viewpoint is often rooted in really deep moral and historical arguments against things like usury and debt. Adherents will cite texts like the Book of Proverbs, which frames the whole lending relationship not as some kind of equal partnership, but as a form of servitude. Now, according to this view, the modern mortgage has a very specific and, let's say, controversial origin story. This theory traces it all the way back to an ancient legal document called a Shetar. To put it simply, the Shetar was a contract that allowed a creditor's claim to be attached directly to a debtor's land. Now, back in feudal England, this was a huge deal because land ownership was tied to service to a lord, not to commercial debt. This timeline shows how, according to this theory, the basic ideas of the Shetar were slowly woven into English law over centuries,
ultimately creating the legal foundation for seizing property over a loan. Okay, now we get to the absolute core financial claim of this perspective. And you might want to sit down for this one because it's a doozy. The theory goes like this. When you sign a promissory note for a mortgage, you're not just promising to pay. You are actually creating a valuable financial asset with your signature. According to this view, the bank doesn't lend you its own money. No, instead, it takes your signed note, it deposits it as an asset on its books, and then it literally creates brand new money, credit, out of thin air, based on that asset's value. It then loans this newly created money back to you and charges you interest on it. The really shocking conclusion here is that you, the borrower, were the one who created the value in the first place. And for some people, this is not just some abstract philosophical theory. This here is a real-world example of someone acting on this exact belief. They've taken their mortgage statement and they've stamped it with legal-sounding language like accepted for value and adjust the balance to zero. They're trying to use this whole commercial theory to basically cancel out the debt with the very bank that issued it.
So, okay, we have two completely different ways of diagnosing the problem, right? And as you'd probably expect, that leads to two completely different ideas about the solution. So, how does each side actually fight back?
I mean, the contrast here could not be more clear. The official approach is all about working within the system we have. Report fraud to the FBI, get help from a government housing counselor, keep a close eye on your credit. But the alternative approach, it's all about challenging the system itself, questioning a court's authority, filing specific government forms to try and commercially discharge the debt. It's a fundamental attempt to reframe the entire process as a commercial transaction that the borrower can actually control.
So where on earth does all this leave us? We've just walked through two completely irreconcilable stories about the exact same financial product. A product that, let's be honest, our entire society is built on.
You've got one view, a legitimate system that's being targeted by criminals. And on the other hand, you've got the view that the system is the crime. The whole point of this explainer wasn't to tell you who's right, but just to lay out as clearly as possible this profound disagreement that exists right at the heart of our economy. So we'll end with this one question for you to think about. In this incredibly intricate web of promissory notes and deeds and securitized trusts, a system so complex that these two completely opposite views can even exist at the same time, who do you think truly holds the power?